Hi, welcome to Bond Bytes, the daily bond market highlights from INR Bonds. I'm Arjun Patsarthi. And in the economic survey today, the predictions for forecast for economic growth for this fiscal year, which is the next fiscal year, which is fiscal 22 to 23, is expected to be around 8 to 8.5%. For this year, it's been revised from downwards from 9.5% to 9.2%, largely on the impact of lockdowns and supply shortages. While the government is pretty much, the survey is pretty much benign on inflation at pegging it at 5.2% for this year. But as consumers will let you know, inflation has been far, far higher at the consumer level than what the official estimates suggest, with rising fuel, very high fuel costs, and all other costs being rising extremely fast. The markets, the centers also, the revenue growth has been very strong in the April-November period for this year, for FY 21-22, growing at almost 67%, and this is very positive. So this could potentially lower the fiscal deficit sharply. The fiscal deficit for this year was pegged at 6.8% of GDP. And the expectations are that it can come down to around 6% or even lower GDP into the next year. The only thing which the market will be watching for is how the government manages its fiscal deficit, and how large will be the government borrowing. So in terms of whether the budget will be positive or negative for gsec yields, in the sense that if the market believes that borrowing can be managed and is pretty much lower and can be managed easily by the RBI, the gsec yields can largely stay around current levels. And but the cause for it coming down sharply is not there at all, given that rate hikes are in the offing on global scale. And if the budget is slightly populist, then it could have inflationary impact as well, apart from the fact that the economy is seeing very strong inflationary pressures on the input prices. And if clearly the borrowing is exceeding market expectations and fiscal deficit is higher than what the market expects, and the government is not really committed to its fiscal responsibility targets, then you could have the market worrying a lot about inflation and populism and borrowing, and this could potentially take up government bond yields sharply. Government bond yields today came down, gsec yields came down sharply, around 7 basis points, indicating that the market expects a benign supply of bonds. But the fact that the central government plus the state governments will start to supply bonds starting April, the markets will start to again worry about the supply, as well as March is a month where Fed will start to hike rates, and all that is going to play on the market's minds as it goes forward. Thank you very much for listening in. Do not forget to download our Quick Invest app from INR Bonds, where you can see the bonds that are listed and see the information given, and invest in the bonds for your portfolio, through the app in a very easy investment process. Or the download links for iOS and Android are in the description below, or you can just go to the app stores, and download the one by searching Quick Invest by INR Bonds. If you're not subscribed to our YouTube channel, please do so. Thank you very much.